Welcome back, everybody, to Volatility Trading Strategies. So we started a fresh new week here in late March 2020 with yet another down day in the S&P 500. The Fed injected even more stimulus into this economy, really going full kitchen sink mode at this point, and still it didn't seem to stop the bleeding. The S&P 500 is down 34% from the high, and is now at the same level it was at all the way back in December of 2016. This is not a political statement, just a point of interest, but that means the S&P 500 has wiped out all the gains it made, plus a little more, since President Trump's inauguration in January 2017. 3.5 years of stock market gains, at least for buy and hold investors, which unfortunately is the vast majority of people, gone in 1 month. So an absolutely staggering market drop here. Now, hopefully you've all found ways to mitigate the investing losses, and even more importantly, just to stay healthy during all of this, so stay safe, everyone. But during an epic market crash like this, we've seen a record number of traders jumping into the long volatility ETPs that are supposed to do well during market crashes. Buying VXX, buying UVXY, TVIX. I've seen countless blogs, videos, tweets this week talking about how it's the easiest trade in the world. You just buy TVIX and money falls from the sky, right? At least according to all these trading gurus out there. Well, you can see the dark blue line there, the S&P 500. It is down minus 6.4% in the last few days. So anybody long TVIX should be making big money at this point, right? But actually, the TVIX is down nearly 57% in the last few days. It touched an intraday high of 1,000 a few days ago, and now it's all the way back down to 400. So if you are one of the ones holding TVIX, thinking you should be making big profit while the S&P 500 continues to collapse, you must be feeling very confused right now. I've seen so many people talking about how the TVIX is broken, it's manipulated, it's the big banks suppressing volatility. All kinds of theories as to why it's down so big. So today I'm going to explain exactly what's going on with TVIX and why it's down so much. So subscribe to the channel, and if you want to support my work, just smash the like button for me. That'll let YouTube know that my content is worth ranking. So let's get into talking about the crazy roller coaster ride known as TVIX. So the answer as to why TVIX is down so much, despite the stock market also getting crushed recently, lies in how the TVIX actually works. I can't overstate this point enough, but TVIX is not a stock. It doesn't derive its price based on the regular supply and demand dynamics. A bunch of people going out and buying it because they're worried the stock market's going to keep crashing, that action of buying TVIX shares doesn't cause the price to go up. I know that sounds crazy. People are so used to buying and selling stocks. They think that if a bunch of people go out and buy it, then the price goes up, and if they sell it, then it goes down. And yes, the vast majority of the investing world operates on that dynamic, but not volatility ETPs. All three of the big long volatility products, VXX, UVXY, and TVIX, derive their price based on changing values of the front 2 months of the VIX futures, and how those VIX futures converge to the VIX index at expiration. This is the VIX futures term structure. You can access this yourself at VIXCentral.com. Every point on this chart represents a monthly volatility price, April, May, June, all the way out to November. Traders can buy and sell these futures based on their market bias. So those long volatility ETPs derive their price solely, and I mean only, on the changing values of these two VIX futures. We call these M1 and M2. That's it. They hold a composition of M1 and M2 VIX futures, and every day that goes by, they are holding slightly less of the front month M1 future and slightly more of the back month M2 future. We keep rolling forward in time, and every month, exactly 30 days prior to the next month's S&P 500 expiration cycle, the VIX futures expire. On that expiration day, the front month M1 converges to be the same price as the VIX index, and then it expires. The front month M1 drops off the board, M2 becomes M1, M3 becomes M2, all the way down the curve, and the cycle starts fresh. Now I have a full video explaining the VIX futures expiration cycles in detail. If you trade the volatility ETPs, I strongly suggest you check out that video after you watch this one. As these VIX futures change value, and we are constantly moving forward in time towards the next monthly expiration, the net asset value of the volatility ETPs, the NAV of TVIX, will change. This is the only dynamic that is affecting its price. Now, of course, there's definitely a strong longer-term correlation between the S&P 500 and the VIX futures. That is to say, if the S&P 500 is going down, the VIX futures will tend to be moving higher. That long-term correlation does exist. But it's very important if you're going to be holding TVIX to understand that it's not the action of the S&P 500 that's causing its price movement. It's not supply and demand. It's not because a bunch of traders are going out and buying volatility in record numbers. It is only the value of those VIX futures. So if the question is, how is it possible that the TVIX is down over 50% in a few days, even though the stock market has also crashed, the answer is actually relatively simple. That blue line is the VIX futures term structure on March 18, 2020, and the black line is for March 23, 2020. Now, something I calculate for the VTS community to help everybody get the most accurate numbers is based on how many days to expiration the current monthly cycle has, we can calculate what is called VX30. It's just a simple number representing the value of both the front month M1 and the back month M2 futures with respect to the number of days to expiration. So that blue line for March 18th has a VX30 value of 70.48, and the black line for March 23rd has a VX30 value of 48.80. That's a percentage decline of over 30%. Given that I've said TVIX derives its price based only on the value of that VX30 and how it moves as it converges to the spot VIX at expiration, the TVIX will follow it downwards. It has to, it's not a stock. It's just a predetermined methodology, and the changing values of VX30 in relation to VIX is all that matters. So if you're a little more savvy a volatility investor, you might be saying to yourself, well, the VIX futures are still in backwardation, so that in itself should make the TVIX continue to go higher, right? The top chart is the VIX futures term structure in what's called contango, upward sloping, and this is what we see in stable markets. Under these conditions, long volatility ETPs have a headwind, and it would not be a good time at all to be holding VXX, UVXY, or TVIX on the long side. The bottom chart is the VIX futures term structure in what's called backwardation, downward sloping, just like we see when markets are crashing, just like right now. Under these conditions, it's a tailwind for long volatility, and products like TVIX do have strong pressure to go up, and it did from about $40 to $1,000. But despite us being in pretty steep backwardation here, the VIX futures is a free market, and that VX30 value, the combination of M1 and M2, has crashed. And TVIX is a 2 times leveraged long volatility ETP, so it's going to crash twice that much. TVIX went up very strongly, and then recently has crashed quite violently. So we know why TVIX has crashed. It's just a function of its methodology and the fact that the VX30 has dropped. But your next follow-up question might be, why did the VX30 drop, and is that going to continue? Well, this could be a video in of itself, but just a short explanation here. This is a chart of the front month VIX future, VX in many trading softwares. When the stock market is crashing, traders and especially large institutions rush out and hedge their portfolios. They can't just dump everything. A, they don't want to lose their fees, but B, the volume isn't feasible, different needs for different clients, tax implications. There's many reasons they can't just dump their portfolio and move to cash. So they hedge it, and one of the places they hedge is in the VIX futures market. VIX options and index options as well, of course, and the same thing applies there. But the VIX futures rise quickly as the hedging ramps up. But at some point, most of the big players are adequately hedged, right? Premiums on those long volatility positions become so high that it no longer makes sense to keep buying more. It's unsustainable. On March 18th, last week, we hit a level that is higher than anything during the height of the financial crisis in 2008. So it's only natural that at some point it's going to slow and start dipping back down again. So the first part of the equation is, TVIX is crashing because its price is based solely on the VIX futures market, which has started to deflate. VX30 is down almost 30%, so the double leveraged TVIX is getting crushed. The second part of that equation, why has the VX30 collapsed? In a nutshell, anybody who did require hedging probably has enough of it right now, and the sky-high premiums just make it inefficient to keep buying more. Now, does that mean that everybody's hedged and TVIX is just going to continue its slide from here? Well, nobody knows. The stock market could easily take another strong leg lower, and that may actually juice the VIX futures premiums again. But if you are long the volatility ETPs here, say long TVIX for example, just be aware that you do actually need that to happen. You need another acceleration of fear. Because if the market just hangs out here, even if it doesn't go up, it just stays flat, those long volatility ETP prices will continue to go down. So just be aware of that. Think of it more as an acceleration of volatility rather than an absolute level. In order for TVIX to get anywhere near where it was before, you do need an acceleration of the stock market crashing to the downside. And also keep in mind, we are talking about long volatility ETPs that are down over 99.99% since inception. Getting the timing right and actually making it out with a profit on the long side is a big challenge to say the least. Most people are going to be better off not going long or short these volatility ETPs. They're complicated products, they're highly risky, so just keep your allocation small, keep your risk well defined. That's the best way to play this uncertain market. So if you're a volatility junkie and you want more analysis just like this, head on over to my website, claim your free trial, and see if the VTS community is right for your long-term investing goals. See you next time. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.